In theory, the cash basis system of accounting is much simpler than the accrual basis. For a great many small business bookkeepers, it can be a little daunting to set up a formal accrual basis system. When I first started as an accountant in a small town on Canada's west coast, most professional accountants would receive cash basis accounting records from their small business clients. They'd typically adjust to accrual before preparing financial statements and tax returns at year end. It was simple and straightforward for our clients and for us as their accountants. The business only had to categorize what went through their business bank accounts. This approach works, at least for many small businesses, because almost all business transactions eventually find their way into the bank account. In other words, the difference between cash basis and accrual basis records is really a timing difference. If you sell something, you put money in the bank when you get it. This is true whether you sell for cash only or offer credit to your customers. The payoff from using the cash basis system is that the number of entries is vastly reduced. In this presentation, we'll show how credit sales and accrual basis system actually require 4 entries. For comparison, the cash basis really only requires 1 entry at the time the deposit is made. The same is true for businesses that get credit from their suppliers instead of just using credit cards, for instance. Of course, you're not supposed to use the cash basis in Canada when you file your income taxes, unless you're either a farmer or a fisherman. Then, as allowed by Section 28 of the Income Tax Act, the accountant could select either the cash basis, as defined in Section 28 of the Income Tax Act, or the accrual basis. Apparently, the smart people who wrote the Income Tax Act thought the accrual basis was too hard to understand for the poorly educated types engaged in farming or fishing businesses. I'll read out the provisions of Section 28 so you can see for yourself how much simpler the cash basis approach is, as allowed by the Income Tax Act. Farming or fishing business. Subsection 28(1). For the purpose of computing the income of a taxpayer for a taxation year from a farming or fishing business, the income from the business for that year may, if the taxpayer so elects, be computed in accordance with a method in this section referred to as the cash method, whereby the income for that year shall be deemed to be an amount equal to the total of A, all amounts that 1. Were received in the year or are deemed by this act to have been received in the year in the course of carrying on the business, and 2. Were in payment of or on account of an amount that would, if the income from the business were not computed in accordance with the cash method, be included in computing the income from the business for that or any other year. B. With respect to a farming business, such amount, if any, as specified by the taxpayer in respect of the business in the taxpayer's return of income under this part for the year, not exceeding the amount, if any, by which 1. The fair market value at the end of the year of inventory owned by the taxpayer in connection with the business at that time exceeds 2. The amount determined under paragraph 28(1)(c) for the year. Paragraph 28(1)(c) with respect to a farming business, the amount, if any, that is the lesser of 1. The taxpayer's loss from the business for the year computed without reference to this paragraph and to paragraph 28(1)(b), and 2. The value of inventory purchased by the taxpayer that was owned by the taxpayer in connection with the business at the end of the year, and D. The amount of the total of all amounts, each of which is an amount included in computing the taxpayer's income from the year from the business because of subsection 13(1), 80(13), 80.3 sub 3, or 80.3 sub 5, minus the total of E. All amounts. Well, you catch my drift. As you can see, even something as simple as the cash basis of accounting sounds an awful lot like source code. Well, so much for the tax department making things simple. Oh well. While the accrual basis is a little more complex than the cash basis, a set of cash basis records can be converted fairly easily to the accrual basis at the end of the year. So the accrual basis isn't really rocket science, even if your accountant would like you to believe it is. Depending on the type of business, only 2 or 3 entries are really necessary to convert cash from cash to accrual basis. First, you need to determine whether there's anything owing at the end of the year from customers who were invoiced but haven't yet paid. Second, you need to determine whether the company owes money to others at the end of the year. The typical approach to making these determinations is to scan cash received or paid out after the year end for the first couple of months or so. You then try to determine which accounting period the amounts relate to. Finally, you'll need to examine the inventory of goods available for sale or for services yet to be billed at the end of the year. These unbilled services are commonly referred to as work in process or work in process inventory. It is a little more complicated than that, since you will also need to reverse out the corresponding entries from the prior year. So you would have set up accounts receivable and accounts payable and inventory in the prior year. You now have to reverse those out and then set up their corresponding values for the current year. In this presentation, we'll explore how the bookkeeper can accomplish this, and if and when the business would benefit from adopting a proper accrual-based accounting system. So in this slide, we're going to look at the accrual basis and recording a sale on account. What we mean is you sell services or product to a customer in return for a promise to pay at some point in the future. Very common in the business world. So here we have a sale happening on January the 4th, invoice number 1 for 5 hours of labor, and we debit accounts receivable and credit sales. Next, we'll look at the collection of the amount owing on January 6th. So on January 6th, we put $500 into the bank, we debit the bank, and then credit accounts receivable. So we now have a debit and credit in equal amounts. So the balance in accounts receivable is 0, and there is now $500 in cash in the bank. So in this slide, we're going to take a look at a cash basis sale. In the previous 2 slides, we looked at an accrual basis system recording the sale on account and then the collection. In a cash basis system, we take things a lot more simply. So instead of recording those 4 entries, we're simply recording the one item hitting the bank. We know that it went into the bank, and we know that it was from a sale. So for the time being, all we do throughout the year is record that one side of the entry. So in many respects, it's a very simple system. A simple cash basis system can work because in business, just about everything finds its way into the bank eventually. That's if you're not trying to hide your money by keeping it under the mattress. There is a bit of a timing difference between when the sale is made and when the money actually hits the bank. In a cash basis system, we simply ignore the first part of the transaction and wait until it hits the bank to record it. I often work with small technology companies that only have 1 or 2 clients. For them, a cash basis system is surprisingly efficient since they only need to access the bank records. They can let the bank record all of the transactions and they simply categorize them. In our example, we looked at a very small business using both an accrual basis and a cash basis system for a single sale. This same approach can work, the cash basis approach, that is, um, if the business only has a very few customers or if they don't offer credit terms, but only sell for cash or some other kind of immediate payment like a credit card. It can also work if they have a separate invoicing system or an accounts receivable system like PayPal or FreshBooks. If you only have one or two clients, it may be enough to produce your invoices using a spreadsheet or a word processor and then store them in Google Drive or Dropbox. However, the more customers you have, the sooner you'll drive yourself nuts with this approach. So it's generally the complexity around invoicing and receivables that first drives small businesses to implement a computer-based accounting system. Another benefit of using either a full-blown accounting system or an invoicing system is the ease with which your customers can pay you. Most systems integrate with a payment processing system, making it simple to pay using a credit card or something similar.